Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 101, titled Hitting a Double on the Last Day of a Contract. And we're going to show you and talk to you about a real life example I used with Invesco QQQ Trust, which trades on the NASDAQ exchange under the ticker symbol QQQ. Now, one of the exit strategies that we use in the BCI community for covered call writing is known as hitting a double. So let's start by defining the term hitting a double. This is one of our covered call writing exit strategies, and we use it when we buy back the call option when the stock price goes down and wait to see if the price then recovers. If it does, then we could resell the same option in the same contract month with the same cash investment, thereby generating two income streams. If we were to envision what a chart pattern would look like when we hit a double, we would see the price of the stock declining early in the contract and then recovering. So we would have the classic V-shaped chart pattern. And this would then create two income streams in the same contract month. Now, because of theta, time value erosion, usually the opportunity for hitting a double and the opportunity to generate another income stream is normally referred to the first half of a contract. However, there are times when the market is so volatile that we can actually hit a double towards the end of a contract. In this podcast, I'm going to show you a trade that I made where I actually hit a double on the very last day of a contract because the market volatility was so substantial. So let's turn to that real life example with QQQ, which is an exchange traded fund consisting of 100 of the largest non-financial companies that are listed on the NASDAQ exchange. So on April 20th, I purchased 100 shares of QQQ at $215.50. We're going to show you this in 100 share, one contract increments to make the math easier. Percentages will be precisely the same. Then I sold the May 2020 220 call at $5.70. And then, of course, I placed my buy to close limit order to close the short call at 20%, which was $1.15. And then on May 3rd, I changed that 20% buy to close limit order to the 10% guideline because it was in the second half of the contract. So that 115 was then changed to 60 cents. And nothing happened until May 15th, 2020, the very last day of this contract. The buy to close short call threshold was met at 60 cents. So that short call was bought back. But because the market was so volatile at that point in time, what happened was the price of the stock zipped back up again, showing that classic V-shaped pattern. And I was able to sell that option for $1.54, the very same 220 call option for $1.54. So I was able to hit a double, and that resulted in a net credit of $94 plus 154 minus 60, a net credit of $94 per contract for 2 minutes worth of work. And that was related to the fact that I had that 10% buy to close limit order in place that was executed automatically. Because the market volatility was so significant, I didn't roll down, but I was able to get that bounce on the stock and sell the very same option. Now, for those of you watching this podcast, here's an actual screenshot of one of the contracts, and you could see the buy to close at 60 cents on the bottom line, and then on the top line, you could see the sell to open at $1.54. That's $94 per contract. You know, if you had 5 contracts, that's almost $500 additional cash generated into your account using the strategy of hitting a double. Now, had the price of the stock not shot back up so quickly, I could have always rolled down to generate additional time value premium. Now, again, for those of you watching this podcast, I'm now showing a screenshot showing that classic V-shaped pattern. You can't miss it when you look at the chart. Boom, it goes down, and boom, it goes up. When it goes down, buy to close. When it goes up, sell to open. It's not luck, folks. It's the crossing and the intersection of preparation and opportunity. So let's summarize now. Position management is the third of the three required skills for option selling. First, we have stock selection, then we have option selection, and then, of course, position management. We always set buy to close limit orders after entering a covered call trade based on our 20%, 10% guidelines. Now, these opportunities can arise anytime during a contract. Sometimes they don't. But when they do, it can happen at any time, very early in the contract or very late in the contract, as I showed with this particular example of QQQ in the May 2020 contracts here. So before I go, folks, let me mention my favorite and what I consider our best BCI package, which is an acronym for our best and most comprehensive educational product ever offered by the blue-collar investor. It consists of 6 online video courses with downloadable workbooks, 6 BCI calculators created by the BCI team, found nowhere else, and 5 of our best-selling books in ebook format, along with an annual premium membership, which is 13 months of membership. And this package will give you everything, and I mean everything, you need to have to master the strategies of option selling, both covered call writing and put selling and related strategies. Now, a lot of folks ask about training. Does it include training? It includes way more than just training. We didn't just give you a couple of training sessions with this package. We gave you ongoing and never-ending video training. We add at least one training video in your member site every single month. Part of the Ask Alan video library, there's about 200 of them. We keep adding one every month. Blue Hour webinars, where we add a few in-depth webinars a few times a year. But every month you will get at least one new training video. We archive these on the member site so you can go back and review these. So it's way better than just adding a couple of live training sessions. We archive video training sessions and leave them on the member site forever. So that's part of the continuous training that we offer as part of our membership. Just go to our website, www.thebluecollarinvestor.com. Click on that BCI package link at the top of the web pages, and there will be more information along with a video explaining all the advantages of the package plus the 20% discount inherent in that package. Ladies and gentlemen, I want to thank you very much for taking the time to listen to and or watch this BCI podcast number 101, hitting a double on the last day of a contract. Folks, I hope you enjoyed this presentation, and more importantly, hope it puts money in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.